Hello, everyone. This is Mark with Semantics Trading with the Daily Report. So today we did see the largest decline in PPI since 2020. Even though that we had gotten through these inflation numbers this week rather unscathed, we do have expiration next week, which can provide some funky market action. And we do have a few things to consider, as we do have to wonder what other things can support us in equities. Perhaps one is that the idea of a pain trade where the net exposure currently is underweight and there's not enough cash deployed can lead to chasing of the market by CTAs or other funds. But we do have to consider that there are many other market risks that weigh us down. And at the current moment, we do have a lot of liquidity in the system sloshing around, and the Fed has barely begun its tightening cycle. So, once one must ask themselves, is equities getting way too ahead of itself? We do see a divergence between what the Fed is saying and what the markets are pricing in. The markets are telling us that we are going to get rate cuts next year, while the Fed's Evans has said recently that we won't pause at all. So it is a good question to ask yourself, who is the right in this debate? If the Fed is right, then the market will have to price in more rate hikes, which leads to higher 2-year yields and more volatility. It's hard to say what will happen in the future, and perhaps we may keep rallying, past even above 4,300 before we turn over. But if we do have a slip up in data, we can easily see a spike in volatility, and as a result, that could soften equity markets. At the current moment, there's a lot of complacency in the market, as shown by VIX falling in the last few weeks. And in the short term, the technicals are suggesting higher on SPX. But when we look at volume, it is quite low, which is very typical of a summer session. And as we're approaching the part of the season where volatility generally picks up, it will be quite interesting, as seasonality may take into effect. But overall, we do have a technical bull market, but it is quite fragile to many risks, and any little slip up can cause this to revert into sort of a purgatory of sorts. And we do have midterm elections coming up this year. And with the midterms, my thoughts are that if we do have a gridlock, I think that could be very positive for the markets. Because if we're able to achieve that, then the only stimulus can come from the Fed. Ella Rain, who's an economist and the president of the Queen's College, and former advisor to Alliance, said that during the post global financial crisis, the Fed kept rates low because there was no fiscal stimulus coming out. So with this idea, if the Fed were to be the only game in town, then they could provide they are the only ones that could provide stimulus for the economy with easing credit channels. And this can be realized with pausing the tightening or even rate cuts if this gridlock were to be achieved. So potentially, if we were to get gridlock and the Fed became more dovish and started stimulating the economy, we could see speculators jump in and see long duration assets reach higher levels. And if you take a look at a yield curve, we did have a short end go higher during the soft inflation print, which is in a way sort of supportive of equity markets as you get a less inverted yield curve. But the issue is that you have a higher discount rate, which equities do have to price that in, and that is why we saw growth get hit today. Um, we do see that inflation expectations are being built in the long end, and Fed rate hike expectations are being sucked out at the current moment. Um, Now, if we take a look at the Nasdaq and the U.S. 10-year yield inverted, the spread between a Nasdaq and an inverted U.S. 10-year yield is widening, as you can see. Generally, when a yield goes higher, the risk it raises the risk-free rate, which softens rate-sensitive equities such as tech and growth. So this is something that you have to be worried about as well. Essentially something has to give, and I would be very cautious with this in mind. Now, when it comes to Europe, we might see some contagion from Europe, and they do have a lot of serious issues over there as their economic situation is deteriorating. We do see England stating that there may be some need for some rationing due to blackouts, and there's also reports of European towns shutting off lights. And another thing is that we are witnessing a drought in Europe that is putting stress on key waterways such as the Rhine River, which is reaching low levels not seen since 2018. So why this is significant is that the Rhine River is one of the key waterways linking Western Europe and Germany to the North Sea, and this lane is where the majority of coal imports, raw materials, and finished goods are transported on. So with this shrinkage of water levels, this is likely going to have a large impact on the supply chain for Europe. And with that being said, that is it for today's recap. I want to thank you all for watching, and be sure to subscribe and like the channel if you did enjoy the video. Thanks.